answering your tough financial questions for the past 26 years. It's Allworth's Money Matters with co-hosts Scott Hanson and Pat McClain. Would you like an opinion on a financial matter you're dealing with? Whether it's about retirement, investments, taxes, or 401ks, Scott Hanson and Pat McClain would like to help you by answering your call. To join Allworth's Money Matters, call now at 833-99-WORTH. That's 833-99-WORTH. Can't get enough of Allworth's Money Matters? Visit allworthfinancial.com/radio to listen to the Money Matters podcast.
Welcome to Allworth's Money Matters. I'm Scott Hanson.
And I'm Pat McClain.
Glad to be with you on, we're broadcasting this on June the 6th, and here in the studio, and it's nice to be in the studio. Sometimes we've done some stuff from home, but we are in the studio today, practicing social distancing,
We are
of course.
back in the office.
Yeah. As our world slowly kind of
Comes
reopening the economy.
Who knows?
You wouldn't know that anything had really changed with looking at the stock market. Look, for every investor needs to remember this season.
That's right.
In the future, when you look at something, you think, oh, maybe stocks, maybe whatever asset class it is, maybe things are overpriced, or I think things are going to go down, or I think things are going to go up.
So I was talking.
Nobody, 6-7 weeks ago at the bottom of the market was predicting that the stock market would come back 30% in a few weeks.
It's
while everyone's still unemployed.
It is. So I was talking to David Schauer, who is a financial advisor,
Chief market strategist here at Allworth Financial.
I was talking to him this morning, and I'm like, "What? Explain it to me." He's like, I have no idea. Right? And
you can flip on the news channels and some talking head will give you some excuse because they stick a microphone in someone's face and says, give us an excuse. And so they give an excuse so they can get PR out of it.
It may be a lack of alternatives. It may be a lack of alternatives because commercial real estate is probably in the worst state you could ever imagine because no one knows whether anyone's going to return to an office. The whole world has changed. Rent prices in Silicon Valley have dropped by 15% year over year. So even apartment buildings in places where you've seen them run.
Although my daughter lives in Denver, right near downtown, whatever the district, some kind of, if you're over 30, you're not welcome. Kind of
okay, is that right?
Well, I've been there a visitor. That's what it feels like.
It's like
I'm just kidding. No,
it's like an apartment at Chipotle's.
Yeah, it's all hip area and it's near the cool park. It's like, and her lease is up on her rent, and I thought I was going to be able to, negotiate pretty heavy on helping her get and there's hardly any vacancies around. Wow. And I thought, come on. So Dad's going to swoop in and solve the day.
How big of a discount did you get?
I'm probably not going to get any discount.
No. It's, this is...
Which is bizarre because these are younger people that, many of them are professionals, college grads, be able to work from home.
But it speaks to asset allocation and not market timing. If nothing does, this does.
An asset allocation, by that you mean having an investment strategy in place prior to whatever crisis may or may not come and sticking with your strategy regardless of what the external circumstances are telling you.
That's right. I mean, who could have called this rebound? Anyone? I'm not that smart.
And it was, if you look, I think it was Wednesday, the Dow was up another 500 points or something. And this is the time. Trump tends to lose friends every week, and this last week he pulled a couple stunts that just even his closest people were on him, and the market. It's like
there's a complete disconnect. You see rioting in the streets, people breaking into stores, looting,
and the stock market goes up.
And the stock market goes up. Like
unemployment levels we haven't seen since the Great Depression.
And the stock market goes up.
We don't know if we'll ever have a vaccine for the COVID-19 coronavirus.
And the stock market goes up. Go figure. Anyway, it speaks 100% to asset allocation and not market timing.
Have an investment strategy that's not based upon trying to just figure out the whims of investment sentiment, because that's what dictates price short term, not economics, investor sentiment. Whether it's the price of stocks, real estate, gold, doesn't really matter. Bitcoin
doesn't make any difference. It makes no difference. You're right.
Long-term economics matter.
Well, correct. And sometimes there's lack of alternatives. So money needs somewhere to go. And well, anyway, let's do our radio show.
All right. This is our radio show.
Okay.
Both myself and my co-host here, both financial advisors, certified financial planners.
I just feel like we're talking like in normal, like these are the conversations we have in normal life. Well, I guess that's the radio show, huh?
I think that is the radio show. That's why we've been doing this 25 years and
it's almost like,
so.
Yeah. Anyway,
so if you
know what we're thinking because we're saying it.
Pretty much.
I hope.
I try to. I'm sometimes to my detriment.
Okay.
My filter's not always that great.
Okay.
This is me, take it or leave it.
Oh, I'm known for my filter. That's what they go, Pat the filter. That's what they call me.
Always slow to respond. Has
never an opinion.
Never argumentative in the slightest. So passive.
I know. It's like I wasn't even a middle kid out
Was Pat there last night? I don't remember.
Not even like I'm a middle kid out of five children.
I mean, Pat and I've worked together a long time. Pat is one of those guys. You go out to dinner, not always, but most of the time, he's the kind of guy who's got everyone just rolling in stitches. And there's something about it. You like feed off it, too.
Oh, it's great.
And he can be so funny at times, and everyone's just dying laughing. And then the more, it just kind of, then you just get funnier and funnier. And
well, it's awful.
Of course, it's been a few months since we've had a nice dinner party.
Oh, a nice dinner party. What's that? I mean, listen, my children have come home and, yes, they're living with me, and
it's a dinner party every night.
I don't know. No, it's not a dinner party. It's like everyone goes their own way because they were college kids. They were living on their own, and all of a sudden,
I had to apologize to my son because I tell you this. It was on Mother's Day of all things. We just finished online church, right. And the kids are all home, and it's supposed to be a nice time. It's Mother's Day, and my son. I don't think he tries to provoke me, but he just some comments he was saying, and about this,
and he's very, very liberal.
Yeah, he just finished college. And he was taking a class on social injustices.
You're relatively conservative.
Relatively, I mean, I'm not.
I'm fiscally
if I thought a libertarian would be elected, I'd probably vote libertarian. Anyway, but one, I'm a little older, and when I was younger, I was tending to be a little. And so he starts ripping on capitalism. And
is he doing it on purpose? Is he trying to provoke something?
I don't think so. But he's 22 and he's thrown back at home, which wasn't his plan. Lost his job was taken, and this isn't what he was expecting, right? So I don't know if he meant to or he's just kind of frustrated.
But he didn't realize that capitalism actually bought the house you're living in.
Oh no, he had me watch. What was the Wall Street? 10 years ago, there was the Wall Streets were the bad people, and there was Occupy Wall Street.
Oh, got it.
He had me watch an Occupy Wall Street documentary on the airplane as we're going to college tours.
Okay, is that right? All right.
So real quick, and then we'll get to the calls. But so he says something about negative about and I finally couldn't help it. I said, realize that capital has been the best thing to alleviate people from poverty of any other system. I said, it's got some horrible things. And he says something back, and I said, it's really easy when you're young and you haven't done anything, and all you do is sit around and talk about how bad the world is and point your fingers. I said, wait till you're in the world for 10 or 20 years, and these are very complicated problems that aren't solved that easily. So you and your buddies just sit around and talk about how bad everyone else is doing, what a bad job everyone else is doing.
On Mother's Day, was your wife there?
She was. And he got up and he said, I found that very offensive personally and to a lot of my close friends. And
then
my wife looks at me like,
Happy Mother's Day.
I'm thinking I've been caged in too long. All right, we got to get some calls
let's
here.
Let's get so this is a financial
and I love my
show.
son deeply.
Of course
he's my son, my only son.
You don't have any choice.
Well, I do. And I respect a lot of his feelings and opinions.
Yeah.
833-99 Worth to be part of the program. And we're going to Denver talking with Dale. Dale, you're with Allworth's Money Matters.
Can you hear me?
Yes, sir. How can we help you, Dale?
Okay, so I retired this year.
Congrats.
And
what a strange time to retire.
Yeah, actually I retired last year, but
Okay.
this year I'm taking money from my traditional IRA, having taxes withheld, and I'm getting Social Security,
Okay.
the full amount of Social Security.
How old are you?
And now I'm 66.
Okay.
So now I've got this tremendous amount of, well, not tremendous amount of money, but some money in traditional IRAs, a traditional IRA, and I want to start moving some of that to my Roth IRAs without getting killed tax-wise. Anyhow, I think taxes are the biggest problem.
And do you have much money outside of retirement plans in a savings account, a brokerage account, mutual funds, stocks?
Yes. I've got, well, let me tell you what I've got.
All right.
I've got about $250,000 in cash.
Just straight
I've got
cash.
Straight cash.
Okay.
I've got $350,000 in a Roth and $1.7 million in traditional IRAs.
All right. Are you married?
I'm married.
And what's your income?
What are you projected to be for 2020?
If I continue what I'm doing with taking money out of the traditional IRA and my Social Security, that's about $107,000 a year.
So that is probably after your standard deduction, assuming you took a standard deduction. That's right at the period where you bump from 12% federal taxes to 22% taxes. So if you can,
Right.
if you take much more out and do a conversion this year, it's all going to be at that higher tax level. Question for you on this: why are you taking, instead of taking money from your traditional IRA, why don't, instead that dollar amount that you're planning on taking, why don't you convert that amount to a Roth
Yeah, and
and live off some of the cash?
and live off the cash.
That's kind of why I was getting your opinion on that.
That's exactly what you should do. That is the right thing to do.
That's how I'd play this.
Okay, so then I'd be paying 12% on.
That's right. And so what you're doing is converting money from the IRA into the Roth IRA. So what we're planning for is the required minimum distribution at age 72 in order to try to lower that.
Yep.
So we're thinking 6 years in the future.
Okay.
But
How
no sense spending the money that's coming to the IRA because you've got $250,000 in cash.
And how much money are you taking out of the IRA every year?
$77,000.
All right, that's an easy yes. So spend down some of that cash, convert from the IRA to the Roth IRA, and do a pro forma on the tax return. And actually,
Yeah, you
determine
might
the
want to
amount.
take a slightly less. I would look at right where the tax rate goes. Well, unless you're thinking your tax rates are going to be higher than 22% by the time you reach age 72.
I don't want them to be.
Well, okay, because mostly because you're not happy with how the money is being spent when you give it to the government. But so
Right.
I agree with Scott. I'd look at converting that and spending down the cash.
Well,
And
that's
every
what I
year you can reevaluate. That's the nice thing, right?
So what is that dollar amount that I need to stay under to stay at?
So
12%?
For married, the tax level is about just over $80,000 of taxable income, which is after some deductions, which goes from where the rate goes from 12% to 22%. And the right way to do this, Dale, is to really run the numbers.
But Scott, we did a virtual seminar this week called "A Bull in a Bear Market." We talked about Roth conversions, and I assume that's on our website.
Yeah, it's on demand.
It's on demand, and I would go watch that
Because it lists. We talk about Roth conversions. We list the exact.
dollar amounts.
It's the taxable amount after your standard deduction.
So it's called a bull in a bear market, which we created this thing 6 weeks ago, and apparently we didn't realize.
We didn't know that it's a bull in a bull market, I guess.
Right. So, but one of the points that we actually brought up was it's probably a good time to actually think about Roth conversions. And if you watch that,
But Dale, you're thinking exactly right, because I look at your situation. You've got $250,000 in cash. You already have $350 in a Roth IRA. So there's no sense. I mean, if you can move that $250,000 cash to have it all, even 100% in the Roth, that'd be golden.
and you're just doing
Because
it
you know-
another way,
This is a way to take your cash and move it all to a Roth.
just by spending down the cash, converting the money from the IRA to the Roth IRA, and it gives you more flexibility for withdrawals in the future.
Yeah, because you could always take the Roth. If you need cash, you could always take the Roth out without any tax consequences. And I think this is the right thing. And it's an interesting thing, I appreciate the call, Dale. The interesting thing, when it comes to our retirement plans, there's many restrictions until we're age 59 and a half. Early withdrawal penalties, etc. Then at age 72, we have these required minimum distributions. So the only years that we have with great planning is between 59 and a half and 72, particularly when you look into when we should start Social Security.
Correct. There's tons of flexibility.
And it's all the kind of planning that goes.
But he's got a really great diversified tax structure.
Totally. I mean, if you could get to retirement with a couple million, a little more than $2 million, almost $2.5 million, and
So, but
with
Scott,
a good structure between outside of retirement accounts, Roth, and traditional.
so when you look at this, he's 66. He's got 6 years, but he's drawn down $77,000 a year out of his IRA. But if you think about it, that's taxable, so he's not spending all of that. Some of it's going to taxes. So he's got 4 or 5 years that he can actually look at conversion
Yeah.
from IRAs to
That's
Roth
right.
IRAs.
That's right.
And at the end of this, he could have $600,000, $700,000 in his Roth.
Or more.
Yeah.
Yeah, it's a good opportunity. All right, to join the program here, 1-833-99-WORTH is the number, 833-999-6784. We're talking with Ron. Ron, you're with Allworth's Money Matters.
Great. Thanks for having me on the show today. A long-time listener.
Thank you.
Been to a couple. Yeah, you bet. My wife and I have been to a couple of the live seminars way back in the day when you could actually go to a live seminar.
I don't know when that'll be again.
We did. So we did a virtual.
Right.
We did 2 of them this last week, and it was quite interesting sitting in my office talking with
Home office on a headset.
150
Yeah, I know.
people. Strange world.
How can we help?
Strange world.
Yeah, enjoy the format. I always tell people, if you want a good laugh, tune in, and you might also get some great financial
Oh, thank
advice.
you.
Thanks. Well,
You bet.
I hope
Hey,
it's
so my
more the
question
latter
are-
than the former. But
Yeah. Also, so my wife and I are looking to buy a second home in the Nevada side of Lake Tahoe. We're within about 5 to 7 years of retirement.
okay.
And my question revolves around, we've got about $50,000 in cash, which won't be enough for the whole down payment. So my question is refinancing our primary home and taking out cash to augment the cash that we have in savings. Is that the best way to go for a down payment on the second home?
Well, let's start with what is the goal of the second home? Because are you going to move to? So we live in California, but Nevada's 2 hours away. I actually have myself a home in Nevada, a second home, probably close to where you're looking for a home.
And is the plan for you to retire and leave the high tax state of California and move full time to the low tax state of Nevada, zero tax state of Nevada?
Yes.
That's the goal.
So in 5 to
Yeah.
7 years, you will leave California and sell your California home.
And retire
Or
there.
possibly rent it out, but have the primary, living in Nevada.
And can you afford 2 mortgages in both now and in retirement?
So that's a good question. We can afford now. Currently, my wife had been putting about $1,000 into a 403B.
Yeah.
She's going to stop that. We also are looking at making sure that we find a place that has some short-term rent out capabilities to possibly help offset that. But that would not be 100%. That would just be, kind of a cherry on top to help out with that.
Okay, so for the little you've told us so far, it sounds like a stretch. Like you're stretching to do this, right? By stopping the contribution to the 403B, doing forward the payments on a second home. And by the way, your homes are not an investment. You consume them, right? And a rental home in the Lake Tahoe Basin, very rarely, even if you rent it, it's a break even at best. So you're hoping for price appreciation is what you're hoping for. So the mere fact that you're actually scrambling to try to find money to do this tells me that you probably shouldn't do it. That you're probably better off.
Unless the plan was to truly, I mean, if 5 to 7 years from now you can sell your California house, take that cash and pay off the Nevada house, then we say, go for it. But otherwise, it might make more sense to wait when you at the time to go. You're probably better off going and renting. It's going to be cheaper for you to go rent whatever you want, whenever you want, for the next 5 to 7 years.
For a couple of weeks at a time. And one of the problems that we're actually seeing in tourist area is the fact that because of Airbnb and VRBO, is that short-term rentals are becoming cities are actually outlawing them. So
Sure.
if you called me up and said I had $200,000 in cash and I could make this thing easy, I'd say go for it.
I mean, I've owned a cabin in the mountains for 13 years. They're just expensive. I've told my wife it's like if we had ever given to that'd be like the first thing to go. I enjoy using it, but they from a financial standpoint and the winters are hard on them. And
it's complete luxury.
It really is.
It's complete luxury.
And from a dollar standpoint, unless you're going to be there a few months of the year, 3-4 months a year, and maybe you are. Otherwise, you're from a financial standpoint, we could run the numbers, and unless there's been price appreciation of double digit.
But when you said that you were going to stop the deposit into your wife's 403B in order to make this thing work, I would just wait.
So refinancing our current one, we currently own 95, about 9 years to go. It's valued at about $325. So refinancing and pulling out money, that would not be advisable.
No.
Well, I don't like the concept of having to reduce your retirement distributions to make a mortgage payment on a second home.
Because it's not the same thing. So if you plan on...
You'll make a lot more money by having the money going into your 403B than you will by having a second home that
consumes.
Yeah.
Perfect. Okay,
right.
great.
So, but if you want to move to Nevada, if you want to move to Nevada,
hear that, but
look, if you want to move to a lower tax, just wait patiently, pay your home off, and then pick up and move when you're ready to move.
Okay.
But stretching for it is not. It's not the way.
Yeah, and use those funds to almost have hopefully no very small mortgage, if any, making that move.
That's exactly right.
Retirement.
And maybe take a few $100 a month less into retirement and say we're going to use these dollars to go rent somewhere for a few weeks a year.
Yeah.
Sure.
The numbers from a numbers standpoint, we've got lots of clients that have. You run the numbers; they're horrible investments.
They're awful. And you're talking. Listen, it was for me. I bought a place on probably where you're thinking is the east shore of Tahoe. You're probably looking at Zephyr Cove or around there, right?
Yeah, either there or Incline.
Okay, so well, first of all, Incline is a lot more expensive than Zephyr Cove.
And by the way, Incline Village, they call it Income Village. If you're, they say the billionaires are pushing out the millionaires.
That's right. That's right.
Larry Ellison has a home there.
Oh yeah,
all those.
Dave Duffield from people.
Michael Milken. They all got.
They all yeah.
Who's
they call Billionaire Row.
Yeah.
Yeah. So anyway,
so that's not where Ron's looking at mine.
No, he's not on Billionaire Row.
No, I don't think so.
They are nice estates, but so just wait.
Yeah, and I know it's not the advice you always wanted. Well, and I appreciate the call, Ron. One of the things that we've said often in our both on the air and our firm, it's like we tell people what they need to hear, not what they initially want to hear. Because we've seen people come into our office, they say they're planning on retiring in 2 months. And we look at the numbers, we're like, you can't afford to retire. And they say, well, this broker at this other firm I just met, and like, well, that's because they've got a financial interest in having you retire so they can manage your money. We're just telling you, you can't really afford to retire. So one of our values is making sure that we tell people what they need to hear, not necessarily what they want to hear.
Even if it's bad news.
Even if it's bad news, like you can't retire.
I always just think, if you were my brother, what advice would I give you? We try to bring it home.
Yeah, like anyone's like family, exactly. Yeah. We're taking a quick break. You're listening to Allworth's Money Matters with Scott Hanson and Pat McClain. We'll be right back. Having gone through 4 economic downturns in 30 years, you get used to people asking tough financial questions. I'm Scott Hanson with Allworth Financial, and today I'm getting more questions than ever before. Should I stay in the market? Should I reallocate my investments? Should I postpone my retirement? Well, there are a lot of folks clearly worried about their money, so if you have questions, we're happy to answer them. Just ask at allworthfinancial.com.
Can't get enough of Allworth's Money Matters? Visit allworthfinancial.com/radio to listen to the Money Matters podcast.
Welcome back to Allworth's Money Matters. Scott Hanson.
Pat McClain.
We're taking calls.
Yes.
833-99-WORTH is to join Allworth's Money Matters. Be happy to.
Yes, and strange new world. Different.
I would, yes. It's really, what'll be interesting is the world is, it's kind of, things are opening up. And I know different parts of the country are different. Some places have been much more open longer.
But we live in California.
We live in
the
California.
People's Republic.
There's still a shelter, stay-at-home order.
Yep.
So, I was talking to my wife. I said, one of the challenges, I said, they're opening these restaurants up and like even some fine dining up. And they're encouraging you to go keep the social distance. But I said, how is that essential? I mean, if the state orders for me to stay home and they're opening up parks, but
how's that essential?
Well, how am I'm not in compliance with the law. The law still says stay at home.
Okay. I don't know. No idea.
I would like them to change it to strongly advised stay at home.
Is that right? We'd appreciate it if you stayed at home.
Yeah.
But I tell you, I have friends that own restaurants, and there's $600 a week federal unemployment. They cannot open back up because they don't have enough employees. They're working reduced hours. One friend owns 7 restaurants, could only open 3 of them because he can't get the employees. Unintended consequence.
Yeah, brutal. Let's take some calls. That's
happy.
Yeah. All right, let's talk with Pat. Pat, you're with Allworth's Money Matters.
Good morning. Long-time listener, and my question is normally dealing with RMDs. I'm 70 years old now, and for the last 5 years, I've been doing approximately 4 to 5% of my IRA and converting it to a Roth. And I plan on doing something like that in the next 2 years.
Perfect.
And I have a regular brokerage account, savings account, credit union account, and the IRA. And right now I do it at the end of the year because I kind of figure out what taxes and what tax rate I'll be in. Whereas after 72, is there a time frame better than another time frame during the year to take out or do a conversion or withdrawal from an RMD?
Oh,
so that's two different things. So one, I like your first of all, it sounds like you've done great.
You've figured it out.
Yeah.
Right?
I like with your help through the conferences and your podcast and your educational program.
Okay,
all right. Well,
thank you.
Thanks
but
for
you've
giving
also
us all the
taken
credit.
It's so funny is I've got some clients 25 years, and well, Scott, thanks to you, I'm like, no, you did the hard part. You saved the money.
We just kind of
worked.
We moved
and then
it.
saved.
We moved
That's
it
the
around
hard
a little,
part.
right?
That's the hard part.
We moved it around a little, but you actually saved
That's
the money.
the hard part. Work and the saving. So for required minimum distributions, I think it makes sense to wait. For the Roth conversions, I think it makes sense to wait till later in the year. Just because, unless you know exactly what your income's going to be throughout the year, there's no real rush in doing it early. When we're on the required minimum distributions,
But why wouldn't you do it early if you have a consistent cash flow? If you knew it and he's retired and he knows what it's going to be,
a Roth conversion,
like in January 1. If you're really certain about what the income outlook looks for
Okay.
the year, I'd do it January 1. But
do you have any clients that could do a Roth conversion at the beginning of January? Typically, people just wait because to see how it doesn't matter.
I do my.
It doesn't really much matter.
It doesn't.
It really
you're
doesn't
right.
much matter. The
It
long-term
doesn't.
scheme of things is not
Do
going
it
to make much difference.
January 1, July 1st, December 15th.
For the required minimum distribution, that is known. We know that January 1st. We know the exact dollar amount that has to come out. So whether you take it out in January or December, some people choose to wait later in the year, primarily because they don't want to spend it. Some people, at what they have it set up so every December, they have the required minimum distribution removed from the IRA. They have the government have their taxes sent to the government, and then they have the money go directly into a brokerage account they have set up and reinvested, so that because they don't day one it's all just transfer. It's an all internal transfer. They never actually receive the money. It's just satisfying the required RMD. And there's others that say, I'm going to use it to supplement my income and set it up on a monthly basis. And every January, they got to figure out what the new dollar amount is and set it up so that each month X dollars drops into their checking account of which they can spend.
But if you give any money to charities at all, you would use a required minimum distribution to do so.
Right.
For sure. It's one of the great last planning things that are there.
Now, I've heard you say sometimes you do it like every other year or every so many years.
Well,
and
except
just
with the
put a lump sum in.
Except with the with required minimum distribution, someone can take the dollars, some or all of the required minimum distribution, have it go directly to a charity, and when you do so, it's not a reportable. That tax is not reportable on your tax return. So, let's say let's say you're forced to take out $20,000 a year, and you have $5,000 of it go directly to some charity that you were given to anyway or wanted to give to anyway. For your tax planning, when you're doing your taxes, your compliance, you only have to report $15,000 of the required minimum distribution. The other $5,000 doesn't even get reported.
So
because most people are no longer doing an itemized deduction, it's another way of getting around.
So when you heard us talk in the past about lumping dollars together and actually giving it to a gift fund or a what do they call them, Scott?
Donor advice
fund. Completely different than directing required minimum distributions into a charity,
which incidentally cannot go to a donor advice fund. It has to go directly to a charity.
which is strange.
I don't know.
It makes no sense.
Crazy rules.
So, but you're doing everything you're doing looks good to us.
Yep.
On the end note, I notice as I get older and because of the situation we're in right now, how do you take the emotion out of it?
Oh, that's your problem.
Well, that is you take the emotion out by having a rational plan when times feel good,
and not reacting to the environment.
and you anchor yourself by reminding you why you set up this plan to begin with, and go back to the decisions that were made at that time. That's how you take the emotion out of it.
Yeah,
And you ignore the news on financial stuff. You got to remember that. Just like every other reporter, if it bleeds, it reads. That's all the news, right?
No, it's if it bleeds, it leads.
I'm sorry, if it bleeds, it leads. And I've just found interesting the last few days. It's almost like the coronavirus doesn't even exist.
Oh, not at all.
Right. And for a while, that's all you read about. But when things are going bad financially, all you hear about is the doom, the unemployment.
But the markets don't say that. I barely got my coronavirus decorations down before I actually had to start putting the protest decorations back up.
That's very funny. All right, I appreciate the call. Let's continue on here. 833-99-WORD.
But how do you remove the emotion? I mean, that's the fact that he actually recognizes there's emotion involved.
Well, it's to remind yourself why you have the plan set up. And often it really comes down to, of those assets that you own, those investments that you own that fluctuate in value, the ones that are spooking you, and they only spook you when they go down, by the way, not when they go up in value, is to look at and say, all right, when would I actually need to sell this for income? When do I need to take this and turn it into consumable income? And if it's 5+ years, then you're like, why do I worry about what it's worth today or this week or this month? I'm going to worry about it 5 years from now.
But the mere fact that he said, how do I remove my emotion, tells us that he's got a pretty good handle on it, because he recognized that emotions are driving some of his decisions. It's the people that don't recognize that emotions are driving decisions, financial decisions.
And they rationalize their decisions in the midst of their emotions.
That's right.
It's different this time.
Yeah,
whatever.
It's not the same.
Yeah.
We don't know.
We don't know what.
We don't know whether it's different this time or not.
Well, every time is a little different.
Yeah,
but here's what we do know.
That's right. Let's go to that. Let's anchor ourselves on that.
A couple things that I believe. Man has not changed much over time, and nor will he. Human nature is
human nature.
I believe that. I also believe that our economic structure of the United States of America, the foundation that was going to be built off, although things change a bit, not a lot. And even if people, the regulations or the taxation, we've gone through other periods like that. The 70s we've had lots of other challenging times economically. But every downturn we've had has been temporary and has been followed by another increase in economic production and an increase in asset values of stocks, companies, real estate.
Go back to the Great Depression.
It's always recovered. All these declines have always been temporary if you're broadly diversified.
Yes.
And you actually own things and not have some strange speculative investment, some weird product or something or something.
You and I were talking earlier this week about these amped up, they're leveraged.
Pat and I both, obviously we read. One of the things that I enjoy about doing this show is it forces me to keep on top of everything, because you never know what question you're going to get, and you just need to be informed. And I had earmarked this, and typically we'll have a little system. We find something, an article that's interesting, and we'll forward it on via email. And we both earmarked the same article this week.
What?
It was about these exchange traded notes, these leveraged exchange traded notes, flipping garbage that Wall Street creates. That essentially, if the markets trade within a band, if they don't go down too far, you're fine. But if they drop below, say, 20%, 30%, you're wiped out.
So the title of this came from the Wall Street Journal.
Why anyone would create such a product that is so damaging to people? How in the world could this be good for anybody? These leveraged exchange traded notes.
What's the name of the article? Bankrupt in just 2 weeks. Individual investors get burned by collapse of complex securities, which tells us
just like the stuff that we saw.
They shouldn't be.
Look, these guys were earning 18% a year in dividends on average. They thought these were great investments, and then they're fine until they're not. Here's a 67-year-old had everything. His whole investment was in this. Now he's bankrupt. I'm sorry, but
that's your
fool
fault.
on him.
Yeah, it's your fault.
I mean, to put everything in one sort of thing.
Yeah, well,
but it's these complex securities, exchange traded, leverage exchange traded notes. What a bunch of garbage. Don't be
brokers working for Citigroup, Morgan Stanley, UBS, and Wells Fargo sold billions of dollars of risky exchange traded funds, or ETFs, in 2008 and 2009. They blew up. They went away for a little while, and then they came back, and they sold more of them. So if you're getting 18% in dividends, Scott,
there's no such thing as a free lunch.
You would think at some point in time that someone would just say, "Why are they paying me 18% when the market, when the S&P 500, the dividend yield on the S&P 500 is about 2%, but I'm getting 18%? I get 9 times what the average is on the S&P 500."
How does that happen?
And you're like, Oh, this
happens
looks great.
because it's structured in such a way that if the markets fell, whatever the percentage was, 20% or whatnot, suddenly you own nothing.
Because you leveraged up and you probably didn't even know it. What's leverage mean? You borrowed. You borrowed and then you borrowed some more and then you borrowed some more.
Triple leveraged.
Just
garbage. They're just
stay
such
away
garbage.
from complex
and
stuff.
the problem is Wall Street creates these products because they're very profitable for Wall Street.
Yes. Right? Because they lend the...
And so one of the, we talk sometimes about, here's why we're in favor of independent investment advice. We're in favor of that model. Now, there are some great advisors at the big banks. The problem I have with that structure is those are the same companies that create these products.
And want you to sell these products if you work at the company.
Of course they do. That's their distribution arm.
Yeah.
That's their sales force, their brokers. So we've got, and they get some sort of commission by doing these, by selling these things. I mean, a few years ago, he's a good advisor. I'm like, why are you still there? I won't mention the big firm it was. I'm like, why are you still there?
So, Scott, we have talked about this for the last 2 years about not investing in what are called BDCs or business development companies.
That's right.
About how dangerous they are. But they look great, and the story, it looks great, right?
What is a business development company?
They lend money to small and mid-sized businesses or take equity stakes in small and mid-sized businesses. So far this year, they are down about 40%. Right? 42. Investacorp they have 3 funds, 42, 32% decline, 38% decline. In the same time period, the S&P 500 is down 5%. Just garbage. It's just garbage. Listen, if someone comes to you with a great idea and says it's different this time, yeah, it will be different. At the end of it, you'll probably have a lot less money. And it will go well for a while.
That's one way to invest. Yeah, it'll go well for a while.
It'll go well for a while. Anytime you put leverage in something, it has a propensity to do two things. It's leverage. It's a teeter-totter. When it's high, it's really, really high. When it's low,
it could go to zero.
It goes to zero.
Yeah. All right, 833-99-WORTH is the number to be part of the program, 833-999-6784. We're talking with John. John, you're with Allworth's Money Matters.
Oh, thank you so much for taking my call.
Yeah, our pleasure.
I have a question about the returning of my RMD.
Okay.
I took out my RMD January this year.
Mm-hmm.
And I don't need my money, so I want to return. And I know it's over 60 days. You cannot do that. But I learned that the CARES Act has said that if you have some adverse financial consequence, you have a reason to return. So
I don't even think you need. I don't even think you need an adverse.
Wasn't it after January? Wasn't it only in February and longer?
So the question is, can you put this thing back? Right?
Yeah. But,
we don't know.
I called my I called my brokerage, and they said because I took it out before February, I cannot return.
That's right.
So there's not,
and the CARES Act did not provide clarity for that. And the CARES Act did state you can take money out and avoid any early withdrawal penalties if you're adversely impacted by the coronavirus.
But it suspended the RMD.
It suspended the RMD. But the challenge was when it came out, it was already 60 days past January. So, and the 60-day rule enables anybody can roll over an IRA once every 12 months, and they take money out. They have 60 days in which to put it back. So some of the talk was, hey, we can get your if you took your required minimum distribution out, you can throw it back in within 60 days, and it's not going to be.
So your broker told you what?
You can't.
I cannot return.
We don't.
How do you say we don't know, Pat?
Can I mention the brokers?
It's irrelevant. But what do you mean we don't know? As of right now, you cannot.
That's right.
You mean you're saying it might happen in the future, in the next
I
act?
suspect that it's going to happen by the end of the year. That there'll be
and another one of these bills that's coming through, it'll take care of it.
It will
Because these
fix
bills,
it.
there's all kinds of. I mean, they're not. It's not these these acts that have come. These
so as of now, you cannot put
stimulus packages, they call them.
the next
all
one's called
kinds
the
of
Heroes Act.
CARES, heroes.
Yeah, it's the and then the next
Well, our
one will
Congress
be
people, they are heroes.
Superheroes Act, like Red Cape Act, whatever, right? Distinguished Valor Act.
So the challenge
It's-
right now, John, there is nothing in the law that states you can take your required minimum distribution that you took out in January and put it back in and avoid paying taxes on it this year.
But call us back in December, and my guess is that there will be something written into tax code that allows for that.
Okay.
But
Okay.
as of now, you can't.
Okay.
So
How old are you, John?
Very good.
no, how
Okay.
old are you?
Oh, I'm 70.
And 70?
You're 70.
Yeah.
Well, you
And
don't
why'd
have a required minimum distribution.
Why'd you take the required minimum distribution? It actually doesn't apply to you.
So you're 72.
Well, I didn't want to take it because I don't fit the new rule. I have to take like 60 and a half. So
They
in
changed,
order to-
the rules were changed.
I already took before the new law changed. They changed it to 72.
that
I already
happened on
started.
December of last year, not in calendar year 2020.
Yeah. So you didn't actually.
Yeah, but I already started last year.
well, you did.
So
So I think so. Based on what you told us, it sounds like you actually didn't take out a required minimum distribution. You just took out some money from your retirement account.
You weren't required to take that
And if that's the
distribution
case,
last year.
I'm not confident that they're going to change the rules that will help you
At all.
because this was not a required minimum distribution
You thought it was, but it wasn't.
because they had changed those till age 70. Because you hadn't started them yet, right?
Yeah.
So,
You
and
need
by
to-
the way, John, it might not be that. I mean,
How big was the distribution?
it's over 60K.
oh,
Oh, all right. Well, listen, you need
That
a
is a big
better
one.
advisor. That's
yeah. Why'd you take it in January?
Yeah.
Why'd you
Well,
take it at
I
all?
thought when you take it, you take it earlier instead of taking it in December. You're going to waste 12 months of investment. You can put it in
No.
investment. So why you wait until
It's already invested.
12 months?
I mean, we had this discussion on an earlier call today, but the fact is, it's already invested. So whether you take it out in January or, I mean,
Yeah.
most people say wait. Most people want to wait because they don't want to pay the taxes until later. They want to actually, they want to continue on that.
I took in January. I invested.
But you
you
took it
get-
out of an investment.
No. I took it from. I have some like in cash.
Okay, well then you could have invested
bonds.
Okay, well, but you're comparing apples and oranges because your IRA that cash could have been invested. So the investment had nothing to do whether the money was in an IRA or out of an IRA. Totally irrelevant.
No, but my investment in the IRA was cash. Because
Okay,
That's a
fine.
that's
But then
that's a
on January
completely
you could
different-
have, but you could have invested that in December or January. It had nothing to do with the fact you took it out and converted it. Took out your required minimum distribution.
It wasn't
required.
It wasn't relevant at all.
Uh-huh.
So
I now agree with Pat. You need a new advisor
you need you
because that just seems
you
strange.
need help.
You can do what you want, but I mean, I think you would really benefit.
He called our show and asked our opinion.
Uh-huh.
And what you asked about required minimum distributions that didn't apply to you at all. So the fact of the matter is, you called and asked, "Can I put my money back in?" The answer is no, because you didn't actually do a required minimum.
just took a distribution.
You just took a distribution that you weren't.
And if you took the
required to do.
distribution because you wanted to make an investment, you could have made that investment with,
Inside of the IRA.
unless you were buying something weird or whatever.
Even then, you could almost buy
Almost anything.
anything.
Almost anything. So anyway, John.
Thanks for the call.
Yeah, I do appreciate the call, and we would probably should.
But you're a much more patient man than I.
What do you mean?
It's complex. Let's just say that.
It is complex, and the rules change. I mean, look at. I think the what was the act that Secure Act?
The
That's
Secure
what
Act, right?
Before the CARES Act.
The Secure Act.
Secure until we found out there was coronavirus. Then not quite so secure. So the Secure Act was.
They were going to call it semi-secure.
That was in December of 2019, wasn't it? That's when it was signed. So
Yes.
right at the end of last year, like December 29th, I think.
And it changed required minimum distribution.
If you weren't on them yet, if you had not been required to take them, you didn't have to wait. You could wait till age 72.
But if you were 71, it didn't apply
If
to
you
you.
had already had to start, then
Yes.
yes, that's what it was. And then this year they suspended them entirely. But most of the time people choose. We had the discussion earlier. If you need the money, I think earlier, if you need the money for your income, you typically have it set up on a monthly basis. Or most people choose to wait later in the year. They keep the dollars invested and they pay the tax.
At the very last minute, convert them out. We do them typically in our firm. The people that reinvest those dollars and not using them from income, we do them in the month of December.
And a lot of like with this setup, you can really have it set up so that your required minimum distribution, you can have keep the same securities if you want for that matter. Have the required minimum distribution come out of your retirement account, go directly into a brokerage account. You can have it so it's at the same firm, same statement, everything. The only downside is you got to pay the tax man when you do that transaction, but those taxes can be withheld and sent automatically. But this year, 2020, frankly, it's a moot point because
it's not required.
there are no required minimum
Which actually I
distributions.
thought was just silly. I just thought that's ludicrous. Out of all the things that Congress should worry about, that's what they
The
spent time-
72-year-old who has too much money in his
Too much
retirement
money.
account.
Yeah.
That's who it applies to, by the way.
Yes. So what percentage
And
of the
you
population?
say, well, I don't have too much. Okay, but you're not, the highest percentage of poverty is in seniors.
Yes, absolutely.
And Social Security provides the majority of income for the majority of retirees.
Maybe not you listening to this show,
Probably not. Hopefully not.
but
So most of the rest of the United States would look at you, and if you're complaining about your required minimum distribution,
you would think you just shake your head.
yeah, right. So, I mean,
And
that's a good place to be in retirement. And frankly, if you do a good job planning, that's kind of where you want to be. You would rather have too much money more money than you need in retirement than not enough.
no, and you deserve that.
Yeah. So, all right, we're out of time. Unfortunately, we are here every week at the same station. Of course, most of you listen to via podcast, so you know how to get that. And feel free to give us a review as well. We always appreciate that. And let some of your friends know about this as well. We'll see you next week. This has been Scott Hansen and Pat McLean of Allworth's Money Matters.
This program has been brought to you by Allworth Financial, a registered investment advisory firm. Any ideas presented during this program are not intended to provide specific financial advice. You should consult your own financial advisor, tax consultant, or estate planning attorney to conduct your own due diligence.